I'm back. We are going to go through another problem. Hopefully this one is a little bit easier, a little bit more straightforward, but as I suggest with the previous video, if you go over the video more than once as you're working your problems, it might be best for you. So let's think about this one. Astro sold 20,000 units of its only product and incurred $50,000 loss, ignoring ignoring income taxes. For the current year, as shown here, during the planning session for the 2014 initiatives, the production manager notes that the variable cost can be reduced by 50% by installing a machine that automates several operations. To obtain these savings, the company must increase its annual fixed cost by $200,000. The maximum output capacity of the company is 40,000 units per year. So if you can see here, the sales are $1 million, variable cost is $800,000, contribution margin is $200,000. With the fixed cost of $250,000, you have a loss of $50,000. Now let's get to the question. Compute the break-even ratio compute the break-even in dollars for the year 2013. So what we have to do, and this is going to take you step by step, which doesn't happen in Pearson, unfortunately, but what we want to do is calculate what the contribution margin would be, and when we're going to compute it. And again, we're doing this by, I would say by units. So let's think about how and what we need to put into these fields: sales, variable costs, and then computing the contribution margin. Okay, so let's put the numbers in. Our sales per unit cost is going to be calculated using the $1 million, which is right here. And what are we going to divide that by? Can anybody tell me? You guessed it. Absolutely right. You're going to divide it by the 20,000 units. So I'm going to take my calculator, if you don't mind. And I'm going to take 1 million and divide it by the 20,000. I get 50. So I'm going to put 50 here, if my computer lets me. Now the variable cost, again, how do we compute that? Well, we need to keep the 20,000 units. That's going to be our denominator. So that's one part. What's going to be the numerator? You've guessed it. It's going to be the 80,000. Excuse me, 800,000. So I'll take 800,000, and I'm going to divide by the 20,000 units, and I get 40. So our variable costs are $40 per unit. So our contribution margin is $10 per unit. Now we have something to work with. Now, how do we compute the contribution margin? We've done that. How do we compute now the contribution margin ratio? What's going to be our numerator? Our contribution margin per unit. And we know what that is, right? What is our next number? Our number is going to be the denominator. And that's going to be what? You guessed it. It's going to be the sales per unit. And we already have that information because it's given to us in the problem. So we know 50 bucks is our sales per unit. What's going to be our contribution margin? What's the number that we calculated? Yes, you're right. The contribution margin per unit is $10. And see, the system here automatically calculates it for you, but you know the formula. You're going to divide the contribution margin ratio divided by the sales per unit to come up with our contribution margin ratio. I'm sorry, I'm talking so much today. So our contribution margin per unit divided by our sales per unit gives us our contribution margin ratio. Now we are going to compute the break even in dollars. What do we need to do? Before we put the numbers in, let's just put in what the calculation is. So what is our calculation? What are going to be the variables that we're going to divide together? Because here we are dividing here. So our numerator is going to be our total fixed costs. What's going to be our denominator? You guessed it, our contribution margin ratio, which in this case is 20%. So I'm going to put the number in here. I think it'll automatically assign 20%. Good. Now, what are our total fixed costs? Well, I'm going to go all the way up and find that 250,000 is our total fixed cost. So I'm going to put that there. So now we know in order to break even, meaning no profit, no loss, we have to earn $1,250,000. Now that's not too bad if you have a plan in place. What they want to do is they're going to install a machine that automates the operation. They'll make it much more profitable for them. So, but this information is quite useful because now they have something to shoot towards. They have a number. They have a real number that they can rely on. If we were to do this, this is where we need to be, a break-even point. If we need to be at a break-even, we cannot incur any additional losses. So let's think about the next problem here. We're gonna compute the predicted break-even in dollars for the year, assuming the machine is installed and there's no change in the sales price. Think about this problem for a moment, and then we're going to work it through together. Now, we have to go back and take a look at the instructions here. It tells us 20,000 units of the only product and incurred a $50,000 loss. Also, they want to reduce their variable cost by 50%. So in order to complete this particular problem, we have to reduce this number or split it in half, because we know they're going to reduce, they're proposing that this change would reduce their variable cost in half. So we're going to be working with a $400,000 number. So we already know what our sales price is, and that's $50. What we need to know now is how do we calculate our variable cost per unit. So if we're going to use this number as our starting point, we have to consider the 50% reduction. So that takes it from 800,000 to 400,000. So then I'm going to take my 400,000 and I'm going to divide it by, again, the 20,000 units. And if I do that, that should give me a $20, I think. It's 400,000 divided by 20,000. Gives me a $20 per unit cost, variable cost, that is. I'm going to put the $20 there. And now we have 30 units. Now, if you're concerned that it's right, let's check our work. And I'm almost certain we got it right. Good. We're on the right track. And that's kind of like the reason why I like this particular software, because you don't have to go all the way through the whole process before finding out if you're incorrect. You can always go back and see where you stand before going further. So now that we have our contribution margin, now we can use the same process that we used before. Now we're going to be calculating the contribution margin ratio. So the first thing we want to do is take our contribution margin per unit, and we're going to divide it by our sales per unit, which we already know what that is. So that's going to be the $50 here, and our contribution margin per unit is going to be the $30 to come up with our contribution margin ratio of 60%. Now we are in a position to see if we see what the break-even in dollars is, assuming our proposal. Now the denominator, as we had before, is going to be our total fixed costs. So we're going to take that. And if we look at our instructions, the total fixed costs are going to be 250,000 plus the 200,000. So that's 450. Remember, the company must increase its fixed cost by 200,000. So we're going to add the 200,000 to the 250. That gives us 450,000. Let's do that. Now, choose our denominator. Our denominator is going to be our contribution margin ratio, right? So what we need to do then is divide by our contribution margin ratio, which we've calculated to be 60%. So now we have come to realize if we're to do this, in order to break even, we have to produce $750,000 in sales. Our break even is $750,000. Now this is a very important concept, because this gives you an idea of whether or not you want to proceed further or whether or not you want to abandon the actual proposition. Can you do it? Can you reach $750,000 in revenues overall as a result of these changes? So as we continue to go through this chapter, you'll start to see that there are a number of questions that an organization can answer when they analyze their numbers in this way. It's very important to know that you never see anything of this nature on a financial statement. You'll never see it in the notes. These are detailed, very, very analytical, very, very micro level type of analysis that can really be performed within the managerial section. And it also provides useful information that is not obscured by rules and process and all of that comes with financial accounting. I hope this particular demonstration gives you an idea of how to compute your break-even in dollars and compute your contribution margin ratio. If you have any questions, please don't hesitate to ask.